Welcome to the RedChip Virtual Conference.
Okay, great. Thank you very much. Good morning, everybody. I am David Riedel of Riedel Research Group. For those of you who don't know, Riedel Research Group is an independent equity research service focused on the global emerging markets. We are an independent equity research service. We don't do any brokerage or corporate advisory, any investment banking or fund management, so we avoid conflicts of interest that are on that side of the business. I founded the firm in 2003, building on my experience as a sell-side analyst with Solomon Brothers and Solomon Smith Barney, based for many years in Bangkok, Thailand, covering Southeast Asian stocks. When I first founded the firm in 2003, there was a lot of discussion in the U.S. about independence of equity research and avoiding conflicts of interest with investment banking, and that really wasn't translating to international research, where the conflicts of interest, if anything, are much higher. So I focused on what I knew, which was Asia ex-Japan, and started doing good bottoms-up company-specific equity research with analysts on the ground in the markets that they cover. I'm a firm believer that there's a lot of good information in the emerging markets if you are based there, if you know what questions to ask, and you have good local people asking those questions. So first we started with Asia ex-Japan, India, China, Indonesia, Malaysia, and Thailand in 2003. In 2005, we added Latin America, which for us is Mexico, Chile, Peru, Brazil, and Argentina. And then in 2006, we added Emerging Europe, which is everything from Poland to Turkey, includes Russia and a little bit of South Africa. Right now, we have 31 analysts in 15 countries around the world, doing a mixture of bottoms-up company-specific work and macro work. I'll be talking a little bit today about some individual investable ideas, as well as a macro overlay that we think about when we're thinking about investing in emerging markets. At Riedel Research, we tend to focus on domestically oriented stories in the emerging markets. As I'll describe today, we really believe that the reason we want to be in emerging markets is because of the outsized profits that can be made there as a result of strong growth in the emerging markets. So we look for companies where the drivers of our earnings are within the borders of that country. So you won't hear us talk as global economy rather than emerging markets in particular. You'll hear us talking about financial services companies, consumer names, retail names, things where the drivers of earnings are within the borders of that country. One of the first questions that I always get when we're talking about emerging markets investing is the confidence that we have in corporate governance, fraud detection, the sort of scandals that can really derail investing not only in the developed world but also in the emerging markets. And we have a strategy for that we'll be talking about today, that I will give you a few key tools that you can use to identify situations that you're looking at where you should be concerned about corporate governance or perhaps comfortable with it. One of the things that we've found is very useful in the emerging markets is to go directly to the consumer or the individual to ask them questions about what's going on in their lives and what their thoughts are about certain brands or industries or products or services. So we do a lot of surveys. We do a very interesting survey twice a year on internet usage and brands in China. This is great insight into many of the U.S. listed technology names that are in China, where we can understand what people are doing. Are they using social media? Are they using Twitter-like services that have become huge in China? And we have one of those coming out soon. I'll give you a contact address to email if you'd be interested in seeing that survey when it comes out. We also do a monthly survey of Chinese consumer confidence. We believe very strongly that the Chinese consumer is probably the most important investment story of the next 3, 5, and 10 years. If you get the Chinese consumer right, you're going to get a lot of things right about China and a lot of things right about commodities, emerging market stocks, and developed market stocks. So we'll be talking a little bit about that today. In general, when we look at emerging market stocks, we look for names that have a return on equity of at least 15%, have shown in their most recent report an ability to show widening margins, a stock that trades below the market multiple, and a stock that has high corporate governance. Now, those might seem like a high hurdle for stocks to find in the emerging markets, but we currently have about 670 companies in the major emerging markets that meet all 4 of those criteria. So we have a big universe to look at, and we're always happy to talk to people about names that are in their portfolio, if they're concerned about them, or if we have issues that we can bring up, or if they're not meeting one of those specific metrics, we can jump on that as well. Moving to the next slide here, hopefully. Hold on a second. Just be a second here. Okay, so why do we invest in emerging markets? Well, we invest in emerging markets because of attractive demographics, where established business models from the developed world can be implemented and provide high growth. And this seems like a somewhat simple approach, but it's got a lot contained in it. We like to find companies that have diverse domestic economies that have good and attractive demographics. We like to find countries where the change in income is really changing people's quality of lives, and they're starting to buy new things and experiment with new aspects of life, like bank accounts, life insurance, stock market portfolios, cell phone access, home ownership, car ownership, and so on and so forth. If you find those kinds of situations, you could find a situation similar to, for example, the growth of cellular telephony in China, where you've got a business model that took many years to reach critical mass in the developed world, reaching that critical mass and reaching those high levels of penetration very, very quickly because of the nature of the Chinese economy and the Chinese situation. So we can find these situations around the world. Just make sure that you're finding that right balance of demographics and ability to absorb established business models from the developed world, and that can drive high growth. We believe very strongly that the balance sheet strength of the emerging economies will mean that they will outperform developed markets going forward as the developed markets deal with deleveraging. We've seen a lot of that in Europe recently with the European banks retrenching and so on and so forth. We think there's many years of that to happen, both among the U.S. consumer and the developed market consumer as a whole. I'd be happy to talk more about that during Q&A if that's of interest. So we think that rising consumer spending is completely changing the dynamics of these emerging economies, and we think that that's going to continue. I'll talk about what we call the third phase of emerging markets investing on the next slide, and hopefully provide a framework through which people can understand what's happening in the emerging markets and what we expect to happen going forward. For those of you who think, oh, I don't invest in emerging markets, it's too exotic and so on and so forth, this is still a very important topic for you, because emerging markets are increasingly driving the earnings, growth, profitability, and outlook of developed market companies. We've done a lot of work recently on Yum Brands, the fast food chain, also on pharmaceutical companies, where their future growth and the stock price performance really depends on them getting the emerging markets opportunity right. And you'll see Yum Brands in recent weeks has suffered as people have become concerned about the trends in China for them. We think there's actually more downside in Yum Brands, and we could talk about that during Q&A if that's of interest to people. Not only are emerging markets consumers around the world important, but emerging economies are important. The Chinese economy today is 37 times the size that it was in 1985. Now the second largest economy in the world, as many of you will know, and really the driver of price and demand for major commodities, establishing the path for inflation and so on and so forth worldwide. So we often say that China's turned into the tail that wags the dog, because it's very important that we understand what's going on in China so that we can understand what's going on around the world. And you can see there the chart from the IMF highlighting over the last decade where the growth in GDP per capita has been, and it's really been in those emerging economies. I'm going to talk a little bit now about emerging markets and what we call the third phase. And just to lay some historical background, we consider the first phase to have been that period during the 80s and late 1990s when manufactured exports were the focus. This was a time when I was living in Bangkok, Thailand, and the stories, the investment opportunities there were really about wage disparities, skilled workers able to do manufacturing products and exports from these Asian tigers that were feeding demand in the developed world for microchips and CD players and so on and so forth. So that was really the edge that the emerging markets had, and that was the focus of most analysis of opportunities. As many of us know, that there was a crisis in Southeast Asia which spread around the world as those economies became overheated as a result of this real focus on manufactured exports. Phase two was really in the 2000s, and this was the commodity boom, where especially in China, a huge focus on infrastructure really drove demand for iron ore, for oil, for all kinds of energy, commodities, everything. And that drove, in turn, the economies of Brazil and Russia, where you had this commodity boom which raised people's incomes, provided an opportunity, for example, in the case of Brazil, for them to really settle their balance sheet at the national level, and now they're a contributor to the IMF rather than a recipient of IMF aid, really because of this commodity boom, which has been a big boost to their economy. I would argue that today, and since 2009, we're in what we call the third phase of emerging markets investing, where there's a focus on the domestic consumer and consumer demographics. This is all about countries that have diverse and dynamic domestic economies that don't rely on external trade and external financing as much to fuel the growth in their economies. These economies, like what happened in Brazil, might receive a slug of capital from the outside world as a result of a commodity boom or whatever, but then they're able to cycle that capital through a developed domestic economy to create a virtuous cycle of growth, expanding wages, expanding consumption, and so on and so forth, with less of a reliance on external financing. And that's a really key thing for policymakers in the emerging markets who want to have more levers that they have some control over rather than being whipsawed by external capital flows or what's happening in the rest of the world. Policymakers in China and India and other places were very frustrated during the great global financial crisis when, through no fault of their own economies were hurt very badly to the extent that they depended on external flows and their stock markets depended on external investment. So local populations aspire to a better quality of life because of connectivity and global information sharing. They can really see that happening, and they aspire to these various things. We've been doing some work recently on luxury brands globally, and we noted that Chinese consumers currently account for 1/3 of sales by Gucci and Prada. And that's not just sales within China, it's sales to Chinese consumers that are traveling to Hong Kong, traveling to New York, traveling to Paris, traveling to London. They are really driving demand for luxury goods worldwide, which is somewhat of a double-edged sword and something we need to think about and be aware of as we look at some of those luxury brands that are listed here in the US as well as in Europe. So what we like in the third phase are countries that have young demographics, a strong fiscal position, and the ability and political will to spend stimulus dollars on infrastructure when needed. This is a very important component of emerging markets economies or developing economies getting themselves in a position for long-term growth. They need to have those port facilities, transportation facilities, healthcare structures, educational systems, everything that they need to drive longer-term growth. So we like countries like China, Brazil, India, and Indonesia, which meet many of these criteria. We don't like as much a country like a Russia, where you've got what I call sort of a one-trick pony investment environment, where if you're interested in energy and oil and gas, great, invest in China. in Russia. But if you're interested in something that has a good dynamic domestic economy that's diverse, deep and resilient, I think you're better off looking at some of the other emerging markets. Now, we talked a little bit about corporate governance and how important that can be. Corporate governance is an important issue in all kinds of investing. It's very important to get to know the people that you're investing alongside and with. And what we've developed is a corporate governance scoring system where we have a service that we provide to our clients where we look at individual tickers or baskets of stocks for them and give them a corporate governance score of 1 to 100. And what we found is a few simple questions and a few simple things can make a big difference in understanding the likelihood of a fraud or some sort of issue, a scandal at a company. We found that looking at the number of independent directors and truly scrubbing that number to understand who's truly independent and who is an important question to answer. Is the chairman of the board also the CEO of the company, or is there true board independence? That's a very important question. Has the company announced a lot of M&A and then actually not closed those M&A activities? That highlights management focus and whether they're really focusing on delivering earnings to the bottom line on behalf of their portfolio shareholders, or whether there's something else going on. Now, this system has helped us highlight companies that turned out to be frauds, like Satyam and Rhino, the Indian company and Chinese companies respectively, well ahead of the market, realizing these guys are frauds. So answering a few simple questions and certainly looking at our score on these companies can help predict and prevent exposure to those kinds of frauds. We looked at the number of companies that had good corporate governance according to our scores, those with scores of 75 or above versus those with bad corporate governance, scores of 50 or below. And over the last 2 years, looking through all of 2010 and all 2011, the good corporate governance portfolio, those ones with the higher scores, outperformed those with low scores by 32, 33 percentage points. So it's not the only thing on which we would base an investment, but it is an important part of choosing the right stocks in the emerging markets. And a few key questions can help get to the bottom of whether there is true board independence, whether there's too much noise at the upper management level, and whether that creates an opportunity for fraud or scandal or some sort of miss. So corporate governance is important, but there are things you can do to ameliorate the impact on you. I talked a little bit before about this survey that we do of Chinese consumer confidence. It's actually run by a company on the ground called Intage in China. It's 1,000 households in 30 cities across China. It's a phone-based survey. It is very robust. It has 5 years of historical data at this point on a monthly basis, about 1,500 data points each month. Really a spectacular data set to look at the correlation between people's interest in sentiment about buying a car, or people's thoughts about real estate prices, or people's views about employment expectations, and the performance of various baskets of stocks, performance of various economic indicators. We talk about this every month, and it's been a great predictor of stock price performance. So I encourage you to watch for our analysis of that, or reach out to me if you're interested in learning more about it, because this is really something that has proven itself to be very useful. Just to bring that up to date, we have just recently released a week or so ago to our clients the May data, and we saw second month in a row of decline. We'd seen a very nice rebound from the lows of late last year when the European crisis was on the forefront of everybody's minds. We'd seen a very nice recovery, but then we've now seen 2 months of decline. Within that, we've seen a very sharp drop-off in intent to purchase vehicles. We expect that to manifest itself in June and July numbers, perhaps coming in well below expectations, and then accelerating towards the end of the year. Industrial production will likely be weaker than expected in the next couple of months, but then recover towards the end of the year. Inflation seems to be somewhat moderate, but people are being a little bit cautious with their spending on durable goods and other things. So there's a lot of good insights that we have, and overall we think that China's headed towards a slowdown, not a meltdown. and they can manage this process, but there's going to be some bumps on the road. And we think June and July are some of those bumps, that we'd be nimble building Chinese positions, and then we'd be thinking about what we can do towards the end of the year to get more exposure. We'll talk about some specific ideas in China in just a minute. Just to highlight a little bit of what's happened last year and what's happened this year so far in emerging markets. Last year, emerging markets were one of the weakest asset classes, down 21% if you look at the MSCI Emerging Markets Index, which is not a great index, but it is what we have, underperforming both Europe and the S&P, somewhat undeservedly, I think, given the fact that they continue to have good growth, but it is what it is, and that's what the markets served up. We had a very strong start to 2012, and a lot of that has retraced. So currently the S&P is up. This is as of last Monday, I think. The S&P is up about 4 percentage points, and emerging markets are down 2% year to date. You've had opportunities to trade around that, but that's where we stand today. We seem to go through these annual cycles of concern about a hard landing in China that never seem to materialize, and I would question people who talk about a hard landing in China as to what they mean. If you're looking for a banking crisis, I don't think it's going to happen. If you're looking for a credit crisis, I don't think it's going to happen. If you're looking for a negative, a true recession, which would be negative GDP growth 3 quarters in a row, I don't think that's going to happen. Will growth slow to 8%? It may well slow. It may well slow to 7.5%. Is that a hard landing? I don't think so. Certainly not by the measures that anyone applies to any other economy. So they've got very strong dry powder. They've got strong reserves. They've got some additional levers that they can put into play to stimulate their economy. So the hard landing scenario, I think, is off the table in China, but the markets continue to be concerned about it, so we do have to be aware of it, even if they're wrong. We talk here a little bit about how we expect the emerging markets economies to continue to outperform. We think real GDP growth is going to outperform. We think there's going to be good opportunities to trade around this. We think that there's been a bit of a disconnect between markets and underlying economic growth. We think that is eventually going to correct, though it can take times where people have a risk-on, risk-off attitude, like we've seen in the last 18 months or so, where they're not looking at fundamentals. But once they do, I think they'll realize that the growth is in these developing economies rather than the advanced economies, and the markets will perform well as a result. Inflation is the big concern in emerging markets. You have to recognize that these households in developing economies tend to spend 55 to 60% of their monthly income on food and fuel. Just to put that in some perspective, in China, the CPI basket, the inflation, consumer price inflation basket, is 34% food. In the U.S., it's 10%. And in that 34% number in China, most of that is the actual raw ingredients prices, not about services and processing and distribution and so on and so forth, but the actual price of rice and pork and soybean and so on and so forth. That's what really drives inflation around the world. So when you see pork prices go up by 50% in China, that's a big deal. Pork prices in the U.S. going up by 50% wouldn't even move the needle on our inflation, but it can have a big impact in a place like China. Fortunately, inflation seems to be easing. You've seen some easing of inflation, as you've seen food prices somewhat mellow out in 2012. We've had big concerns at the beginning of 2008, some concerns in 2011, but now they seem to be moderating somewhat. But definitely something to watch, because it is the one factor that can seriously derail the third phase investing hypothesis that we talk about, and that emerging consumer in those developing economies. So as you can see here, data from the FAO showing the food price index having gone up quite a lot in 2010 and shown some periods of strength during 2011, has been drifting down. The most recent data showed a sharp drop-off in dairy prices, but the real one to watch for emerging economies is the oils price index. Oil seeds are a big part of daily expenditure on food, especially in China. China only imports about 8% of their food that they consume, so it's not really a situation of imported inflation there, but there are a few real headline-grabbing products like cooking oil, which is mostly soybean, but also palm, but mostly soybean oil, and we had a sharp rise in soybeans a few weeks ago, and that was an area for concern, but it has been trending down now. But definitely keep an eye on food prices and especially oil prices, oil seed prices in the emerging markets. The worst case scenario for emerging markets is if you have food prices rising at the same time as you have oil prices rising, energy prices. Because remember the statistic that I quoted where they spend 55 to 60% on food and fuel. That's food as well as fuel for cooking, heating, and transportation. So that encapsulates all kinds of energy. If you get those two things rising at the same time, you can get a consumer in the emerging markets who will switch off very, very quickly and go into a saving mode and really hunker down. And they won't be buying those cell phones and cars and appliances and apartments and life insurance products and so on and so forth that we're counting on for growth as they adopt these developed market products and business models. So definitely keep an eye on inflation, though it seems like we're in pretty good shape for 2012. One of the underlying ongoing challenges for emerging markets has been the tremendous amount of underinvestment from the developed world into emerging markets equities. Developed country investment funds, according to Goldman Sachs, hold about 6% of their assets in emerging markets equities. If they increase that to 10% over the next 7 or 8 years, that'll have a huge impact in demand for emerging markets equities. You've got growth in total investment assets around the world. If you increase the allocation to emerging markets, you could see additional $4 trillion in demand for emerging markets equities over the next 20 years. That's a very big deal for these markets. There's not only money coming out of the developed world that's looking for a home and looking for a return, but also within the emerging markets themselves, there's an increasing savings for retirement and so on and so forth. There can be a huge fundamental shift towards emerging markets equities and emerging markets investing, which we believe will have a huge impact on these markets over the next 10 and 15 years. So we think we've got the wind at our backs in terms of emerging markets investments. We do need to get away from this risk on, risk off question and have people focusing on fundamentals, but we will get there. Just to talk a little bit about some individual countries and some investment opportunities, we'll start with China. I talked to you about the fact that China's economy has expanded so much over the last few years. Actually, this statistic here is 25 times the size that it was during 1990, and it's actually more than that if you go back to 1985. The U.S. economy, to put that in perspective, is 1.6 times larger over the same period, obviously from a much larger base. But the fact that China has arrived in this way is a defining aspect of the global economy today. Having this economy at its rate of growth, being the second largest economy in the world, it has significant implications for all kinds of investing. As I mentioned, commodities, developed market equities, companies that are relying on emerging markets, consumers to drive growth and profits. It is a very, very big deal. So China does have to go through this somewhat difficult transition from being an export-oriented and labor-oriented economy to being more focused on capital investment, higher productivity, more capital-intensive manufacturing. But they're getting there. They're getting there through acquisition as well as through in domestic investments where they're really focusing on factory automation and other things. So find ways to invest in that, and I think you'll be on the right side of trends going forward. So the risks in China, a lot of people talk about what's going on there. I talked about the hard landing concern. I don't share that concern with many people. I think there's some very ill-informed observers out there who believe that there could be, for example, a banking crisis. I I don't believe that the central government, with their trillions of dollars of reserves, will allow the banking system in China to fail. Remember, banking in China is not a private enterprise. We actually refer to the whole industry as the Ministry of Banking. So it's simply a reallocation of funds from one bucket to another to support the banks. It's not even a bailout. It's not an intervention in any fundamental way. It's simply a reallocation of resources, and the banking system can be made whole. So I think there's a lot of issues that people raise where they don't fully understand the structure of the Chinese economy relative to a true free market economy. So one of the challenges true challenges that really focuses, that really develops in China, is that China does have the fastest aging population in the world. There is no question that because of the one-child policy, there will be a huge number of retiring people being supported by a smaller number of working people going forward. That's a mathematical fact. But the Chinese government is working on how to manage that risk. And as I mentioned before, they're very focused on transitioning their manufacturing sector from being labor-intensive, worker-intensive, to being more capital-intensive and automation-intensive. And that's a very big issue. And I think they will be successful with that. One of the silver linings for China with the European crisis has been their ability to reach into the Eurozone and acquire companies that have that high quality, high value add manufacturing processes, automated manufacturing processes that they covet. And they've been buying companies like crazy. So keep an eye on those parts of your portfolio. If you do have exposure to smaller European manufacturing companies, they're likely in the crosshairs of Chinese investors and acquirers, which is a big deal. One of the huge challenges that the Chinese government faces today is this massive disparity between the rich and the poor. I was somewhat surprised to learn during the time of the Egyptian crisis last year that the Gini coefficient, which is a measure of the income disparity, was worse in China than it was in Egypt. So there was actually a less equitable distribution of wealth in China than even in a country like Egypt. Despite their socialist background, there had been such a drift away from that in the last 20 years that the income disparity had really blown out. This is a source of great frustration to Chinese citizens, and something to really keep an eye on. The Chinese policymakers and government people will tell you every single time you meet with them that their number one concern, they have a list of 20 concerns, but their number one by far is social stability. They will remain focused on that. They really have to deliver food and growth and jobs and things to maintain social stability. I would argue that they have a lot of resources and opportunities to do that, and so they will deliver those things, and that's where my views might diverge from others. Sure, they have a lot of challenges, but they do have the political will and financial resources to pull those triggers when they need to. A couple of names that I would highlight. These are U.S. listed names, so they're easy to access out of New York. We cover a lot of names that are Hong Kong and China listed, but for investors who are focused on U.S. listed names, it's been a rough road in the last couple of years because of concerns about disclosure and growth and scandal and so on and so forth. But there are some very good companies out there. I would point to Hogs, H-O-G-S, which is a company that has good, solid growth. It tends to trade around a number, but we think that that number could ratchet up, and we could see the price double from where it is today, up towards almost a $20 figure. We think that the Hogs will get there, and we think that there's quite a lot of opportunity for growth for a company like Hogs. Another name that we think should be on everyone's list is China Mobile, CHL. It is the best position of the Chinese telecom companies. It's one of the best run companies in China, certainly within the telecom industry, has the best management team. Our corporate governance score on the company is 71 out of 100. That is really quite spectacular for a Chinese company, especially a Chinese state-owned company. They keep adding tons of new subscribers, the largest cellular operator in the world, and they have, which a lot of people don't realize, $52 billion of cash on the balance sheet. So plenty of assets. They pay a great dividend. I think the yield right now is in the 4.5% range. Just a great defensive way to have exposure to China and earn a little bit of income on the way, and be exposed to this great management team with this great amount of cash on the balance sheet and good opportunities going forward. Really a very good company that it provides a good opportunity for U.S. investors. Brazil is really, when we talk about Latin America, you're mostly talking about Brazil. It accounts for something like 77% of all market capitalization and trading activity in Latin American equity markets. So when people talk about Latin America, you're really talking about Brazil. It's the largest economy in South America by far. It's the 5th largest population in the world at nearly 200 million. Has had good economic growth, certainly not the eye-popping double-digit growth of China, but good growth in the last 10 years. And what's really happened in Brazil is that you've had a formalization of the economy. You've gone from having a somewhat informal, not very well run economy where not a lot of people had bank accounts or not a lot of people using financial services, a lot of gray market activity. Even people who had formal jobs were paid some of their salary in wages, and quite a lot of it in other kinds of benefits that weren't properly taxed, and so on and so forth. So you've had a lot of focus from the Brazilian policymakers to really structure the economy to get it more formalized, get it more trackable and controllable, and eventually more taxable, which has really helped provide an underpinning of economic stability in a country that for many years was known as an economic basket case. But Brazil has come a long way. We think they've got a lot further way to go. I often say that if you were building an economy for today's economic environment, you'd build Brazil. It's got a big enough domestic population to make a difference where you can get those injections of external capital and then cycle them around a diverse and dynamic domestic economy in order to fuel growth and wages and consumption and so on and so forth. They're self-sufficient in food and fuel. They've got so much arable land and water. It's just unbelievable compared to many of the other companies or countries around the world. They actually, interesting story about their energy independence. In the 70s, the military government was concerned about the oil shocks there, and they didn't want to be whipsawed by external events and things out of their control. So they said, hey, let's develop a domestic energy source, and they focused on sugarcane ethanol, which is ethanol that works rather than corn ethanol, which doesn't work. And sugarcane ethanol can be quite efficiently grown and deployed. And currently, 40% of their transportation fuel is delivered by domestically produced sugarcane ethanol. They have a completely parallel distribution system. All of the cars that are sold there are flex fuel, can take a range of ethanol all the way through to full gasoline, and really an impressive achievement since the mid-1970s. It almost begs the question of where we could be in the U.S. If we take an energy policy seriously over the last 30 some odd years. But be that as it may, Brazil has done a very good job on the fuel front. Also, 83% of their electricity is provided by hydropower. Really a great set of circumstances for Brazil. Some of the concerns about Brazil, they do have a history of hyperinflation and economic volatility. It's both good and bad. The central bank tends to be quite proactive in their movements in terms of rates and cutting off inflation when they see it starting, but also the consumers tend to react quite quickly to signs of inflation, and so they can have a hair trigger response if they start getting concerned. We're also a little bit more concerned on the political front in Brazil, where we have seen a change from Lula, who was quite a pragmatic leader, to someone who's proving to be a little bit more populist and a little bit more difficult to predict. So there hasn't been anything to the steps of sort of nationalization like you've seen like in Argentina, but there's been a little bit of an encroachment on allowing businesses to run themselves the way that they want. So I think that there are a few things to be concerned about in Brazil, but there are great places to invest there. I'd highlight a couple of names, both of them in the consumer space. Both of them have large liquid ADRs. CBD is one of Brazil's largest retailers. They run all kinds of things from drugstores to hypermarkets to specialized stores and department stores. Really a very well-run company, a very high corporate governance score, a very well-respected management and board of directors. We think there's got at least 20% upside in the stock from where it is today, and we think that CBD is a great way to get that exposure to the Brazilian consumer, avoiding a focus on commodities and things, because I don't think that's the strength of the Brazilian economy. The strength of the Brazilian economy is in its diverse, domestic, dynamic economy that's supported by those attractive demographics. CBD is a great way to play that. Another well-run company, Ambev, ABV, which is a leader both in the Brazilian and Latin American beverage markets. As you probably know, both the World Cup and the Olympics are coming to Brazil. Beverage companies like ABV tend to do very well in those kinds of environments. But even without that, Ambev has done a great job consolidating many parts of the beverage market across Latin America and provides a good proxy for exposure to the consumer in many markets. Very solid financial structure and balance sheet, very healthy cash generation, EBITDA margins higher than many of the other global companies because they're able to leverage marketing spend and things across these different countries. And we think it's got 50% upside from where it is today. This would be a core holding for us in a Latin American portfolio, and one I think everyone should take a look at, as I mentioned, along with CBD in Brazil. India is a bit of a conundrum for us. It's got such a great story to tell, and the problem is in translating it to actual action. Second largest population in the world, got some good growth, has good demographics, different than China. It doesn't have an aging population, has a very young population. But unfortunately, the political system there really gets in the way of seeing good growth in India. It may not be popular to say, but democracy really gets in the way of India's success in many ways. 77% of the Indian population lives and works on farms, and they only account for about 20% of GDP. But of course, they each have a vote, and so they don't care so much if national infrastructure projects are built, or if Mumbai gets a new subway or a new bridge or a new port or whatever. They care about their little local issues of having clean water and electricity and schools and so on and so forth, which is great, but it stands in the way of the kind of large-scale infrastructure investment that needs to be done in order to unleash the power of India. So there are opportunities to make money in India. It is a frustrating place from an investor's point of view because you'll continue to get buffeted by these political winds that you don't see as much in China, but still it should be on everyone's radar screen for longer term investment because of the very strong demographics and the strong opportunity there if the political system will just get out of the way and let them do the investment that they need to do from at the national level, spend the money that needs to be spent to really turn around their infrastructure. That's what they need. So the Reserve Bank is very focused on curbing ongoing inflation, which has been an issue for them. You've seen a bit of a spike. It's not hugely high compared to historical levels of inflation, but around the emerging markets, but it is somewhat high. And there's an issue with political violence and issues with Pakistan, of course, which can rear their ugly head occasionally, standing in the way of seeing the true fundamentals of India. But similar to the emerging markets, I think that India will have its day in the sun when people start focusing on fundamentals and start realizing that there's some very good, well-run companies in the emerging in India. Companies like Tata Motors, ADR ticker TTM. As you probably know, they bought Jaguar Land Rover a couple of years ago. There was some concern about the digestion of that, but it's going quite well. They're selling very well into other emerging markets, a wide range of commercial vehicles, buses, and other sort of vehicles. The stock is very cheap, 5 times current year EPS estimates. Just a very strong growth outlook for Tata Motors, a very well-run company. In some ways a proxy for the Indian economy and one of the fewer industrial ways that has an ADR that you can invest in here in the U.S. Another great proxy for the economy is IBN, which is ICICI Bank, a major bank with exposure to retail and commercial banking, a very strong management team, one of the best in the emerging markets. Trades relatively inexpensively for the kind of growth that it has at 1.6 times price to book, and really serves as a good proxy for economic growth in India. Russia, as I said before, we sort of see Russia as a one-trick pony. If you want to own oil or gas, I'd suggest you buy it in Canada or one of the global majors or in Australia or somewhere else where you're not taking the kind of political risk that you're being exposed to in Russia. Russia has a range of companies that have different corporate governance structures, but many of the large oil companies and energy companies do have some significant corporate governance risks or political risks of some sort of intervention or something like we saw in Yukos in the past, where there was essentially a taking of assets by the central government. Very leveraged to Europe through their gas sales as well, so keep an eye on that if you're building exposure to Russia. It's cheap. The markets there are very inexpensive, but I think the cheap valuations are somewhat deserved given the history in Russia. Keep a very close eye on oil prices because they are a big driver of what's going on in Russia. When oil prices are high, there's more money to go around and everyone seems happier. When oil prices fall, it tends to put a lot of pressure on the political powers that be, who in turn put pressure on the business leaders, and that's what leads to corruption problems and things like that. So keep an eye on that. When we're looking at opportunities in Russia, sort of two telecom companies that come to mind, both with very solid dividend yields. VimpelCom, a little bit of the riskier play here, is really has some good upside, but has some volatility. Dividend yield of 19%, somewhat unbelievably. Trades at a PE of 6 times, a firm value EBITDA of 4.5 times. Very good, well-run company, but more volatile. The more stable sort of cousin company, not related, but similar company, 100 million subscriber GSM company called MBT Mobile Systems, and they trade under that ticker as an ADR. Dividend yield is 6%, great return on capital, and a very reasonable PE. That would be sort of buy and hold stock for me, MBT, if I was looking at a Russian name, and VimpelCom would be more of a trade. Indonesia, one of our favorite countries around the world, it is a huge labor force, population of 230 million people, very strong growth. I talked about a diverse domestic economy and not having as much reliance on exports. Indonesia has exactly that. They have a large domestic economy. 30-some-odd% of their economy is related to exports. Those exports are mostly thermal coal and palm oil, which are both very much in demand in both India and China for electricity generation in terms of thermal coal and changes in diets and cooking styles and things on the palm oil side. And then that money really goes into a dynamic domestic economy that provides some very good opportunities. There are infrastructure challenges. There's logistics challenges in doing business in Indonesia. As you probably know, it's a large archipelago of islands, and it's sort of hard to work there. There has been some concerns about corruption. Quite honestly, when we look at corporate governance on the individual company level, some of the best corporate governance companies in the world in emerging markets are Indonesian companies. In particular, there's a corporate family called the Astra Group, ASTRA, which owns Astra International, Astra Agro, and a company called United Tractor, which has corporate governance scores in the high 80s, which is very, very high for emerging markets, and really great corporate family to get exposure to if you can invest locally. If you can't, with Indonesia, you're pretty much limited to a couple of ADRs in the telecom space. PT Telkom, TLK, very inexpensive stock with a good dividend yield. This is the legacy incumbent provider of telecom services in Indonesia, sometimes criticized for being a little bit slow-footed, but really a good cash generator and a very good company. IIT Indosat has good exposure to cellular in Indonesia, maybe a little bit more nimble than TLK, but a very good good company and a good way to get exposure there. We would prefer to have a mix of the two companies. We think TLK of the next 2 to 3 years probably has the better investment profile, but still, both of them provide good exposure to a country that we really like, Indonesia. Another country that we really like is Turkey. We think of Turkey as Greece without all the problems. They do have their own economy and their own currency. They're not part of the euro, but over the last 10 or 15 years, they've really been stitched into the European corporate fabric through a series of joint ventures and manufacturing agreements and things, such that they are exposed to European manufacturing in a very beneficial way. They're a very attractive market for European manufacturers to outsource manufacturing to, because of their location, because of their large population, because of their skilled labor force, and a good environment there. So Turkey does have its challenges, a little bit on the political side. People are sometimes concerned about that. We think that question has been somewhat answered in the last couple of years, but it continues to come up sometimes. It does have somewhat higher unemployment than some of the other markets that we look at 8.3% at the end, as of the end of last year. They do have a current account deficit. One of the things to think about with Turkey is that they don't have a lot of their own resources in terms of energy. So a lot of their exports go to the Eurozone and are paid for in euros, where a lot of their imports in terms of energy have to be paid for in US dollars. So during situations where you have people leaving the euro and going to the US dollar, they can get somewhat squeezed because of that imbalance. So it's something to keep an eye on if people are driving towards the US dollar. I think longer term US dollar, there's probably some weakness there, which will help them, and certainly the lower oil prices are helping them already, but it's certainly something to keep an eye on. Some very good, well-run companies in Turkey, great at getting earnings to the bottom line. A little harder to get exposure to from a U.S. investor point of view, looking for ADRs. There is one very well-run telecom company that has an ADR, Turkcell, very strong cash flows, a lot of cash on the balance sheet. They trade at a very reasonable valuation, good growth, and like I said, a ton of cash on the balance sheet, so that puts them in a very strong situation. If you'd like to look for something that provides sort of a broader exposure to Turkey, there is a well-run iShares ETF, TUR, which has a good balance and good dividend yields. So what we've heard about today is about emerging markets and sort of how to think about the framework of emerging markets. Remember about their fundamentals. Remember about the fact that their balance sheets, both at the national level, the corporate level, and individual level, are in much better health than the developed world. Remember that there are opportunities to look through corporate governance concerns and look down into individual companies and management teams and understand who's really going to be working on the side of minority shareholders rather than against them. These companies are somewhat exotic and further away, but there's a lot of great information available, both from us as well as online, about what investment opportunities are out there in emerging markets. And I think once you find those domestically oriented plays in those economies that have diverse domestic economies that are very dynamic and don't rely as much on external capital, you can find good investments both as trades in the near term as well as longer term buy and hold opportunities. We believe that you're going to see a couple of months of weakness here out of China, and then building towards strength towards the end of the year. And that's going to manifest itself in Chinese equities as well as in the equities of U.S. companies that are related to China and the emerging markets around the world. As people start to focus more on fundamentals and less on fear and risk aversion, they will focus on the fundamental strength of the emerging markets, and we will see some outperformance. I think you've got an opportunity to be nimble and get to know some names here in the coming months, and then start building positions towards the end of the year for a good opportunity going forward. My contact information is there on the screen. I look forward to hearing from you if you have questions about these individual names that I've talked about or the themes and ideas that I've highlighted. You can find us online at riedelresearch.com, and my number's there as well. So I'll take any questions that are out there in just the last couple minutes that we have left.
David, thank you for that presentation. It's very interesting, and we are a little short on time, so we're going to jump right into Q&A here. First question, you mentioned multiple times the corporate governance score. Can you give us a little more color into how you calculate that score? I know that's very important for your research, but if you could just give us an idea of how those scores are calculated.
Absolutely. So when we look at a company, we start with 11 different metrics that are related to corporate governance, and that we've learned over the years have an impact on internal systems and companies having the systems in place to protect from fraud, scandal, or some sort of disappointment to the market. And one of the first things we look at is the composition of the board of directors. How many of those board of directors members are truly independent? If it's 20% or more, we're well on our way. If it's 50% or more, we know we've got a company that appreciates the value of an independent board and is really going to be looking out for the minority investors. So that's something that anyone can do from the information that is available online. Sometimes you have to translate it from the local language, but that is doable. And look out for guys that may have a different name, a different last name, but are somehow otherwise related to the company. And we scrub that data quite well to understand the true composition of the board. Then we look at the pattern of insider buying, whether there's been management putting the money behind their commitment to the company, and that's information that's a little harder to find in some of the emerging markets, but you can find it in some major markets like Hong Kong. Also, if you look at whether they've announced, as I mentioned before, announced M&A but not closed it, and that's something that we found that if there's a lot of announcements of M&A, it tends to create opportunities for mistake or fraud in transfer pricing and things like that between this M&A. People may be buying assets from related parties and things like that, and that's an area of concern. The advantage that Riedel Research has, which is hard for individual investors or institutions to duplicate, is our analysts on the ground then chime in with their attitudes towards the reputation of that management team, and that really comes from their years of experience being exposed to those markets and us having the ability to gather that information. So there's parts of this that people can't duplicate, but I'd be happy to talk to individuals about names. If we have them under coverage, I'd be happy to share our corporate governance score on them. It's something that we do for clients all the time, where they'll show us a basket of names, and we'll provide them with a review of which names they might have to look at a little bit more carefully in terms of a corporate governance due diligence.
David, we're coming across a hard break here at 1 o'clock, and I apologize about that. It's a very interesting presentation. We'd love to have you come back on here and have some more time for Q&A at a future virtual conference. But again, on behalf of RedChip and all those participating, thank you for taking the time to present today.
Great. Thank you very much.
That was David Riedel of Riedel Research Group. His presentation was on emerging markets.
This video is not a recommendation or solicitation to purchase or sell any security, nor does it constitute investment advice. Visit redchip.com for full disclosures on RedChip clients.